All right, so hey, hope everybody's doing well. Today we're going to cover quite a handful of topics. We're going to take a look at this coronavirus and economic impact. Hope you guys are all bunkered in with 20-foot walls all around you, steel cages. Maybe you're on a sailboat with nobody around. Bunker down and get ready for a good webinar. Probably going to be a good long one. If you're interested in a long webinar session, this is what we're probably going to do. We're going to do a little bit of a longer session today. This is going to go out to everybody, the members. I'm going to make it free. So thanks for joining us, for all of you that are coming out. We're going to talk a little bit about health problems. We're going to look at mostly the economic problems and, of course, trading and investing. So we're going to spend very little time on the health impact and health problems. After all, I'm not a doctor, so I can't really discuss these kinds of things too much in detail for you. But what I can discuss is kind of a little bit more about the economic problems that will happen, and then we'll talk more about trading and investing. So for me, I'm really looking more, oh, hey, thanks for joining us. You're saying I'm 30 minutes late from our scheduled session. It looks like we're starting at about 11:30 Eastern time. So I don't know where you are personally, but 11:30 was the goal. So I apologize if there was some misinformation, but we'll try to make this webinar a good one for you to make it worthwhile. So in either case, these are the three main things that I'm looking to cover today. We're going to take a look at health problems, economic problems, and trading and investing. And everybody's view on this subject is going to be different. I've spoken to a handful of different people. I've met different people, yes. You could say I'm not quarantined or anything like that. So discussing some of these things with some mentors and things of mine as well. You see a lot of people will have different perspectives. So for me, my main goal today is not about, debating you or saying, hey, this is the better way, or this is, the way you look at things. Maybe you're the type of person that thinks, hey, I got to be self-quarantined. Other people are going to look at things and say, hey, well, I got to go ahead and live my life. So my main thing is we'll talk a little bit more about kind of the numbers, how things will snowball, and my outlook as far as the market investing and how things will project here over the next coming bit. So let's kind of get started. We're going to go and take a look first at the health problems and health impact. I'm just going to do this real quick because, like I said, I'm not a doctor, so I can't give you these kinds of stats that a doctor would. But all I can do is talk a little bit about numbers. So I want to take a look at kind of influenza numbers, smallpox, chickenpox, these kinds of things. So if you kind of look at numbers by numbers and just look at kind of overall what's going on, what's happening on numbers and the quarantines of what's been happening over the last 100 years or so. First off, let's take a look at influenza deaths. And if you look at influenza deaths, which is similar to this coronavirus kind of stuff, in 2018, 2019 in the US, we've had, 35.5 million illnesses or so, more than 16.5 million medical visits and 490,000 hospitalizations, and about 34,000 deaths during that influenza season. So that's quite a bit, right? So when you look at it, of course, every life matters and it's important, but looking at the numbers here, when you look at the numbers, it's a high number. And when we compare this to also looking at, let's just look at, car deaths in 2018, I'm not trying to alarm you or anything like that. So 40,000 people die just in 2018 in car crashes. So again, there's a lot of people that die in car accidents, but it is important that there's a lot of drivers out there when it comes to cars. So looking at the numbers here, and when you look at what coronavirus here is doing, let's just look at coronavirus deaths. Just looking at the impact here, I forget there's a lot of counts out there. We've got about 7,500 deaths or so, and 80,000 recovered. So on a percentage wise, I think that's pretty good. When we look at illnesses, and this is where I'm going to get to, is really just the government impact and the stock market impact, because that's not my main focus. Like I said, I'm not a medical expert. Everybody's got their own opinion. But when we look at previous things of smallpox, chickenpox, and actually even scarlet fever, if you do some basic research, you'll realize that governments have tried to quarantined people in the past for these things. For example, here is, if we look at, I just pulled up a couple articles for you guys, but you can do your own research, right? So quarantines used to be enforced for polio and scarlet fever. This was an article, what day was it written here? This was an article in 2016 here. And you can see some of these older things. Hey, certificate of release from quarantine. Just history shows you, 1945, April 3rd, 1945. So, the government, when it panics and freaks out, and they have no idea what to do, will impose military law, quarantines. They will impose, and this is what's happening in society across the world. Ultimately, you are now in the government's control, and the government is controlling you. They're confining you to your residence, to your homes, to closing things down. They're closing businesses down. And ultimately, when we look at these things and we look at the numbers, more than likely, in a simple kind of context way, more than likely, the coronavirus will be a little bit more problematic as far as deaths are concerned than influenza. Because if we look at influenza, as we talked about, hey, greetings from Chicago. Well, greetings. Greetings, Juan. Hey, thanks for joining me. When we look at influenza deaths, one of the reasons why I think, and looking in, seeing some of the doctors, what they've said, the influenza deaths are going to be a lot less than the coronavirus is simply because we don't have a vaccine for it. So what the government is doing now is they're panicking in a big way to, hey, let's quarantine everybody so that way it spreads less fast. So even if you go ahead and let's just say we take influenza and we look at the numbers, out of, let's say, 100 people, you might have 50% where the vaccine will work, right? And out of that 50%, you might have 25% that recover without a problem, okay? So you have kind of these two pools where people get their flu shots, right? You get your vaccine, and ultimately out of the 100 people, you got for some that it works, some that it doesn't, or some that get the flu shot. So you get the flu shot. And now all of a sudden, okay, well, from the flu shot, do you even get sick? So you've got people that get sick and people that don't. And then from there, you go ahead and see the death rate. So because of this flu shot, even then, these flu shots, these influenza flu shots, they still only work about 50% of the time. It could be 62, it could be 36 some of the years. Percentage-wise, numbers-wise, it only works about half the time. And this is why overall the influenza thing is not as scary, is because you kind of have a vaccine for it. But the issue is you still got a lot of deaths. And a lot of those deaths, when you look at the death numbers, the most vulnerable are, of course, the older generation or the older people. You have people that have the immune system problems. So it's usually kind of the weaker candidates. But you still have a ton of deaths when it comes to influenza. Now, the coronavirus, the reason, of course, let's just call it corona, it's going to be such a bigger problem, at least initially, is because there's no cure, there's really no vaccine that you have. So because of that, there's nothing that can slow it down by 50%. And this is what, in a way, people are now starting to spiral out of control. They're panicking because it's a new thing. Anything new is kind of amazing. Whether you have a new iPhone, whether you have a new disease or something new border policy, this is where the problem in a way lies. And oftentimes, once the disease itself gets that vaccine, then the numbers will still be kind of similar to maybe influenza, or you look at chickenpox or smallpox. Just like we've tried to quarantine and have vaccines for these kinds of things. Like, take a look at scarlet fever again. Like I said, I'm not a doctor, but even then, when you've tried quarantining things, there's still 11,000 to 15,000 cases each year, and still 1,500 deaths. So you're still going to have death. And my long point here is that the genie is out of the bottle. So trying to go ahead and quarantine people isn't going to work in the long run, because now the disease is out. All we can do is now build immunity for it in the long run. get some kind of vaccine to where maybe half the time it'll work. And ultimately, from the looks of it, and a lot of what the doctors say is the economic impact is much more problematic than the disease itself. Because you'll still have deaths, just like you do with car accidents. You still have deaths. You'll still have deaths from influenza. You'll still have deaths from coronavirus in the future. It's just, it'll be maybe more reduced. So anyways, this isn't a health kind of discussion because, as I said, I'm not a doctor. But looking at just numbers-wise, this is what I see. And the problem with that is once the genie is out of the bottle and you have government stepping in to give you restrictions on what you can and cannot do through, of course, this is government action, military action, it starts to create the bigger problem. And the bigger problem is that now you're going to have people that, hey, well, I just need to go run and get groceries. Well, are you going to tell somebody that you're going to be sick? Most people won't. Are you going to go ahead and, if you're shutting things down to where people are totally isolated, even then, people now don't have money. And this is what we're going to get into. We're going to take a look at the economic impact. So again, I know some people will agree, some people won't agree. So there's going to be kind of a lot of different people that will be on this side. So there's going to be a lot of health talk and discussion. So let's kind of look at what's going to happen here economically and talk a little bit about that. And let's look at some investments. So if we look at overall the economic impact and just go ahead and see what's going to happen, I want to start with kind of the top of the chain, and then we can look at it from the bottom of the chain or the middle of the chain. It just really, you can start from the top down or work your way from the bottom up. So let's start from a regular person here. And I just want to talk about the regular mom and pop because they make up a lot of the economy. Because what happens is people spend money, and that $1 creates an economic impact of 10x. So meaning $10. So the mom and pop, what they do is they got a job. And when you have a job, eventually that job will get you some money. That money is then used to pay for your house. It's used to buy your phone. It's used to pay for your electric. You use it to pay for, kids' things, that kind of stuff. Now, right now, what's happening is we're bypassing this, and we don't have a job for a lot of people. They're going to be losing out on jobs because what's happening with the government, they're saying, no, you can't have a job anymore. And the reason they can't have a job is we're closing down, let's say, the restaurants. You're closing down, events. You're closing down a lot of different industries. So as those industries close, let's just talk about the restaurant industries. There's a lot of people that work in the restaurant industry. And what's going to happen is now they've had to lay off staff or go to shorten hours. So when you look at somebody that's making $7 an hour, okay, they have to take that $7 an hour and go ahead and pay for a house. Now, depending on where you live, I don't know, your rent, it could be $1,500, it could be $5,000 a month. Everybody's at different points, it could be $50,000 a month, I don't know. But let's say they take that $7 an hour, and if you're living paycheck to paycheck, right, and you have maybe $500 to $2,000 only saved in your bank account, you don't have a lot of wiggle room. And that's really the big problem with what's going on economically. The restaurants have to close, or they say, hey, you can't come in, you can do pickup only. So they have to close. So the person making money from that, the server, they're not making money, they're not making tips. All of a sudden, that gets them a haircut. So that means they have to decide, well, do I spend money on my phone? Do I spend money on my electric? Do I spend money on my kids? Do I spend money on my, let's say, medical supplies or pills, right? My medicine. Do I spend money on the gas that I have to go to and from somewhere? So all these decisions now start playing a major role when it comes into the economic snowball effect. So the snowball effect, as you can see, creates more and more speed. Just like in the market, the stock market, boom, we've had major down moves, major up moves, major down moves. So with this $7 an hour, you're trying to pay for a house, and you've only got $500 to $2,000. Well, now all of a sudden, your landlord, says, okay, well, your landlord says, well, you can't pay me. Now you're going to get kicked out. You're out. Get out. Because what's going to happen? Do you think the government is going to subsidize? So if we've got big government over here, do you think those people that are, making their millions, do you think they're going to say, hey, well, we'll just give some money to the landlords? Well, hey, why don't we just give some money to the events? Why don't we give some more money to the restaurant? You think it's all going to be subsidized? No. Because eventually those things will end up in court saying, hey, I couldn't pay my rent, I couldn't pay my mortgage, that kind of thing. You'll either have to default. That's where the credit lines come in. You'll have to do bankruptcies. And that's where things get out of control. So ultimately, the viral problem, the deaths, of course, that's bad. But when you look at the overall economic impact, by closing a lot of these things, it creates actually a worse problem for many people, to where you might get into an economic depression now. When you've shut down all these things, you've basically eliminated income to a lot of people. And if you're eliminating income to restaurants, if you're eliminating income to movies, just look at all the things that have been shut down, gyms, movies, then all of a sudden people don't have money. So now you can't go ahead and pay from your wages. You can't go ahead and pay your lawn guy. So if you got a lawn guy, you got to pay him. You can't go out and spend money for movies. So it really just becomes a snowball effect. And that's where we're getting at with the economic problem, is the economics of it, is you're just creating this snowball effect that becomes bigger and bigger. Because of shutting and cutting off one thing or a couple things leads to cutting off more things and more things. You're putting a slowdown on the money flow. Now, what can the Fed do, or what can the government do? They can stimulate. Now, how do they stimulate? So they can stimulate things by, one, reducing interest rates. So they went to 0, I think now. They can flood. If you remember the George Bush checks, the stimulus checks, what are they going to do? Send $264 to every person in America? Well, if you've got a mortgage or rent or whatever of, let's say, $3,000 a month on average, how much is that really going to cover? So long story short, these things never pan out very well. Because it only slows down the inevitable. It slows down what eventually happens. And eventually what happens is you've got an economy that's burning down. And that's the big problem, is the guys at the top are making decisions. They'll either make the decisions based on health or based on economic, or they try to make a balance. But on the economic side, this is the impact. This is a cause and effect, right? So we've got a cause of closures. So I always talk about this, like price and volume, right? If we've got a cause of, the shutdowns, what's going to be the effect? The effect is huge, right? And you've got major, major repercussions, because then eventually, even after these shutdowns, once people start defaulting, then eventually those things go to court. All that stuff. So it's a multi-cyclical problem that will just continue to grow and grow and grow. And that's kind of the big issue. That's going to be the problem. And you've already seen this when you look at just this Twitter things. Here in the U.S., I won't say did the smartest thing. Coronavirus screenings forced travelers to wait hours long at airports. When I saw this on some of the photos, you're basically looking at some of these things and you're saying, right, social distancing, right. So when you do social distancing, again, it's spread now. You can't put the genie back, but you see the economic repercussions of it, that basically it starts to spiral out of control. As you make a decision, it 10x's that. It multiplies that. And this is what's happening, is that the government is putting things in place due to their own panic and fear, and it's creating more snowball effect, or a domino effect, that creates more and more problems economically. So ultimately what's going to happen is, let's say right now, let's say people stay home for 2 weeks. Well, is that going to get extended for 4 weeks? Is that going to be extended for a month? And then again, do we do another month or 2 months? So let's say you're out of work for 4 months. Are you going to have enough money to pay your bills? Let's say you're out of work for 6 months, a year, 2 years. How long can that go on? So it'll continue to cycle and continue to spiral out of control until maybe somebody just says, hey, it's not as bad as driving a car. It's not as bad as getting a normal flu, or until there's a vaccine, or until something else, or until we go to negative interest rates, which eventually then will collapse the currency, and then you'll have even bigger problems. So my long summary of this is, I think what's ultimately happening is the governments themselves are in a panic. And because when you're in a panic, just like you understand probably in the stock market, when you're in a panic, it's not the right time to trade. When you're in a panic, it's not the right time to make decisions. So because the government's operating in a panic, they're making terrible decisions. They're not always the wisest, but they're trying to do something. And, hopefully it works out for the best. But it creates secondary and third and fourth problems to where the repercussions for this, maybe you'll save a handful of lives at the beginning. Again, I'm not saying lives are not valuable, but I'm saying you might save a little bit more lives at the beginning. But what you're going to have is an economic turmoil, who knows, 5 years, 10 years, 20 years. If you look at, I think it's the 60s or the 40s, the charts and the time frames, where you were in a stagnant market. You were basically moving sideways for 20 years. And this is what could end up being in the same context. So if you look at a lot of recoveries, which we're going to start getting into right now, if you look at a lot of economic recoveries in the year 2000, I believe with the dot-com crash, I think the recovery, let's look at the market right itself. I think the down move was about 1.7 years, and it moved down, right? And then we kind of snapped back up. So it's a snap up. In here, 2008, 2009, what we had, I believe, is a 2.3, give or take, could be a 1.5 years. We're going to check it out in a second. Again, the same thing, we've moved down and then we snapped up. So my projection now, because these are specific problems, let's say we've had here the mortgage or loan crises. This one was kind of the tech overvalued.com problem. Now what we have is a global issue where all of these governments are panicking. They don't know what the heck to do. They don't know what they're doing. And the economic repercussions of it is going to be huge. So we're looking at the recovery. You might actually get more sideways like this action for a long time. And then you'll get a pop-up. So long story short, for those of you doing option credit spreads, you're going to love it. It's going to be an awesome market. But, as far as economic growth in the value of things, it's going to slow down business-wise, everything. If this is the type of recovery we have, L-shape for 20 years. So I'll take a look at that. I'll try to find the year that we have that. I think it's in the 60s. But let's start getting into some charts and check out some of the stuff here that we have. So this is TC2000, by the way. If you're interested in the software, there's a discount from our website, I think, just because we're affiliates. But let's check out here the year 2000. So check this out. From the top peak of it to the bottom, okay, it was about 2.2, 2.4 years. Okay, so about two and a half years where the selling took place. 2.5. When we look at here, 2008, 2009, we've got about 1.4 years. That was a 50% down. This last one, we've had 49% in the year 2000. So about 50% downward move. And when you look at this, most of these recoveries were kind of a bounce up. And that's good, right? That's good. But what if this is different? What if we don't get that? Let me take a look at here. I don't know if I can go back that far. I might have to pull up another software here. Let's look at, what is it? Dow Jones Trading View. So bear with me here for a second. And let me see if I could check it out and see if I could look at the long-term history of one of the charts. I'm checking out Trading View here, by the way, Dow Jones. And let's see where I don't use this software as much, but it's really handy to go back many, many years here. If you go into kind of here, the 60s, maybe I can do it. So you'll see here we've got the 70s. Here we've got kind of this market sideways from 1966 to 1981. You can see how sideways we've went. So this is possible right here. So that's a long time. It wasn't quite 20 years. I believe there was another time period. I'm not sure exactly. Where is it? Nope. I think that was it. That was the one I was looking at before. So when you look at this from about 1960 right here. Okay, so if we look at 1960, let me try to fit it there for you. 1960 is kind of where things started, right? We started around this 1960 level, 1957, give or take. We've kind of reached the highs. So this was after a boom, however. And after a boom, the market just kind of stagnated, right? So we boomed, we went a little higher, but you're really trading in this range from 1957 to about 1982-ish, 83. So that length of time, is a 20-year period, 60, 70, 80. And when you look at this stagnant market, I don't know where you are personally in your life as far as age goes, but when you look at this stagnant market here, this is what's possible as far as what's happening with the repercussions, only because of all the snowball effect that happens. So as far as trading goes, if we're looking at some of these things, can you trade and invest in the market? Yeah, absolutely. Are you going to get as good of a returns as you would in the past? Probably not. Is it possible? Yeah, maybe. It depends on how much stimulus they do. It depends on a lot of factors. It depends how much they want to tank the currency. So, there's a lot of factors involved. But as far as trading goes, you'll still be able to trade. The market's not going anywhere. It's just that if you run a business, if you're trying to, deal anything with customers, if you've got a job, if you want a job, you want to apply for a job, those things might be harder. And this is where I think you actually might get into a depression, is because we've had too long of a run up in both these instances with too fast of a recovery. And if we look at where things were here, where we were oversold, and here's the long-term trend line, by the way, that I've been watching with a lot of the coaching students that we were looking at. If that held, and if this still holds, it may be possible. Right now, it looks like it's testing and breaking down. But the thing is remember, you could still be oversold by the same amount that you were overbought. So if you were overbought by this much, why can't you be oversold by just the same amount? Let's say roughly around here. So that'll put us around the 2000, and that's even for the short term. So if we look at kind of this concept, that's what's possible, just on a basic level. Now, if I look at the long term of what's possible, let's say we retract, a full 50%. Well, if we retract the full 50%, we're going to be down to here. And where's that? Look at that. For those of you that love technical analysis, it puts you almost nearly at the highs of these levels, right? So we'll probably snap up a few times. We'll go down. We might snap up. It sounds good. And let's say we go for another 1 to 2 years like this and here. And now the big question is, are we going to move sideways, or are we going to do again a V-shaped recovery? Now the market usually snaps up pretty quick, but that doesn't mean you're not going to have a top again. So if we backtrack this over, and then I'll get to some questions if you guys got some. If you back this up a little bit, so let's say we do come down to this 1500 level. Okay, who knows how long it'll take, 1 year or so. Once we get there, doesn't mean we can't snap up and now move sideways in a range that's like this big, just like in those 60s to 80s. Because then what you'll have is kind of this range right here, the 2500, which is where we were over there. And you'll have this bottom range, something like that, and it might move sideways, okay? Or on the other spectrum, let's say here is our range. We snap down, we kind of recover over a bit. So let's make that a little faster. And then what we'll have is a range at this top level, and we'll be in a, could be there for a long time. So doesn't mean you can't go back up. It just means let's look at the problems here that may start happening as we progress forward. So that's what I would look at as far as these kinds of market conditions are, because, like today, I think today you got like a great day, 102 points up. Yeah, but you had 350 points down the other day on the S&P. So, okay, obviously something's not working. Of course, the market reacts and panics, and that's where you get major sell-offs. In the same way that people buy toilet paper. Why in the world do people buy toilet paper in such large quantities, right? Because was it the run on toilet paper? Here, people buying a ton of toilet paper. You might be wondering, well, what's the reason? Well, it's the biggest economically, right? Let's talk economically. Economically, it's the biggest physical thing that you can buy for the smallest price, right? And it makes you feel good, right? So economically, it makes sense. Now, I know you guys probably don't want to hear it, but when you really look at how other people use the restroom in the world, and even me growing up, we didn't have toilet paper. I grew up in Siberia, so we used newspaper. And the gypsy friend that I had down the door, they had rags with a bucket. And this is an outhouse. Now we're in the middle of nowhere. Of course, that's the way people operated. So it may sound gross, but it just shows you the panic thing creates a lot more problems for economics on the economic side. So anyways, let's take a look at some of your questions here, and let me see if I could answer some of them. Okay, so let's see. I got some BAC also, bro. Okay, so let's check this. Let me see. I get some of these questions. We got some of these on the live chats. I got a ton of them. I don't always look at the live chat. I got some BAC. Hey, lost 15,000 in options last year. I stay away from that. Can't find a good, honest teacher. I got some BAC also. Bank of America. Roberto X has been going negative. Okay, so let's look at Bank of America. Let's check a couple of weeks waiting to reduce the spread of the virus. Okay. China, what is the effect of these economic on Fang, in your opinion? Let's look at that as well here in a second. Okay, in and out. Sasha, what was gold and silver doing at the time? Can you show us a chart? Yeah, let's check out the GLD gold miners is huge. It's still selling off. I mean, those of you that think, hey, gold is the way to go, I don't really think of gold as, it's more of a hedge to make you feel better. I don't think it's, that much better. Yes, we do have a little bit of that cup pattern, and it looks okay, but it's just another way to kind of hedge your bets. And we'll take a look at that. And are you looking at housing and credit bubbles? When the bubble comes, they all come together. We'll talk about that. Do you think there's a lot of investors have moved or made a lot of cash waiting for corrections? Yeah, you're gonna have two types of people. We're gonna talk about that, and that is it. The flyers are gone. Can you provide tech for BHC? All right, let's start backwards here, because I know Manit here is one of the members, so I'm gonna start with him. BHC. Okay. First off, when you look at health companies, I wouldn't jump into any specific company right now just for these kinds of things. I would look for more long-term investing during these kinds of economic conditions. What's going to happen as far as things economically, what's going to happen is you're going to have a lot of people that aren't going to have money. That's what we've talked about. So when a lot of people don't have money, they won't be able to spend, invest, that kind of stuff. And when we look at these kinds of things, you're going to have a lot of people that are going to make a boatloads of money on the downside and boatloads of money on the upside, on the recovery, because they're going to have cash, right? If your cash is tied up, or if you're living paycheck to paycheck, it's going to be difficult. This is the same thing that happened in, let's just look at here, in the spectrum of 2007, 2008, 2000, a lot of these institutions made boatloads of money during this crash and also on this upswing. Because what they do is they dump it, and then later they'll buy some up, and that continues to grow. Same thing here. They'll crash it, and look, who's the federal government bailing out? They're bailing out the big boys, not you. They're not sending you checks. They're bailing out the big companies. So when we start looking at these independent companies like BHC, I look at these, is this a good long-term investing? In my opinion, no, not necessarily. Could I get it for a speculative trade, speculative idea? Yeah, maybe. That's it's speculative. You throw your money and you see what happens. So when you check these things out like this, okay, well, let's look at the support. You're looking at support roughly around this level, around $7-8. So hey, if you can bounce around that level, that'd be great. But as far as, hey, the current volume, it still doesn't look good. So in these kinds of conditions, when you're looking at a major market, the market overall is kind of down. So when you have three types of portfolios, this is what we always talk about, coaching students, members, we look at three parts to our portfolio. We've got our long investments, our medium, and our spec. Spec is like, hey, I want to make like 50 to 100%, but I don't put a lot of cash into it. This is what a lot of day trader people suck you into. In those days, hey, I made $1,500 today. Yeah, great, but you're probably not using your full account, because long investment, this is kind of your retirement money, right? So I always talk with the retirees that we deal with, 50 plus age or 60 plus years old. We're looking at long-term retirement. Yeah, you might make 5 to 10% a year on this, but it's stable, it's safe. And this is really what you want to start building on in these kinds of conditions. Medium term is active investment. Right, so these are kind of swing trades, kind of 20 to, let's say, 180 days. For those of you option traders, you might do 30 to 60 or 90-day trades there. So this is how we break down the portfolio. For those of you new and don't understand, this is, let's say, a $10,000 portfolio. Long, let's say, in this market condition, you might put in 5,000 to 6,000 in here. You might put in 2,000 here and like 1,000 here and some in cash, right? When we were going up a ton in a big upward market, actually, let's just redraw it over here. When we were up at those highs and we kept going up, well, this might only be 30%. So this might have only had $3,000, right? And this might have had 3,000 or 4,000. So, but now what you're doing is you're building the long portfolio for long investments, if you got cash, right? Depends. If you're saving for a house, that's a different story. If you don't, but if you've got cash, you're starting to nibble some. Why? Well, look, Microsoft is down in big time, right? You look at these panic buyers. Warren Buffett talks about it. You're down 30% on these things, right? We look at here, Bank of America. Somebody was talking about Bank of America. Same concept. Look, we're almost back here, 2016, 2017. That's kind of election time, right? So you look at back to those lows. In a way, if you look at just where we were, stock market, Trump versus Obama. Let's just check. Whereas I think there's an interactive chart or something. I think we're kind of right when the election happened now. So we've had all this boost, again, not getting political or anything. But now recently, you're kind of back to this level. You're back where he was. He's kind of stagnant as far as the market goes. So when you look at these investment opportunities, this is good time for that long investment, because you're back right here at where we were in the year 2016, right? So this is a good time to start looking at investments. It doesn't mean it won't go lower, but if you've got a 10-year horizon, it's not bad. It's not a bad thing to take a look at. Okay. Let's check out some of these other comments. Is it a good time to buy mutual funds? If I'm getting into things, this is the way you do it. This is how you do it. Time is your best way to reduce risk. So no matter what you buy, mutual funds, they're all diversified. If you look at ETFs, you're just as good to just buy an ETF and pay your $5 in trading fees, or free if you're using an app or something like that. So you're just as fine as doing this as a mutual fund. Let's say maybe in one you make 8.9%, the other one you make 8.7% per year, for conversation's sake. Well, are you really gonna want the mutual fund fees? No. So just get yourself an ETF like a SPY. Again, not recommendation to do it. Talk to your personal advisor, but SPY, IWM, that kind of thing, and kind of go from there, because they're already diversified. And what you do is, here's your January, February, and let's say 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Here's your months. And if you were trying to put in, let's say, $10,000 into these investment accounts, well, this is the time you start. The market's down 20, 30%. Well, maybe I'll go ahead and put in right now $2,000. Hey, that might not be bad. Wait a month or two, okay? Put in another $2,000. Wait a month or two, put in another $2,000. Wait a month or two, put in another, and you continue this process. And then eventually what you do is you lighten up your load. So then you might go 500, 500, right? Because now you're starting to reduce your load. Now, that's kind of what you're trying to do, because now you've got this economic downturn, but you don't know if it's going to last another 3 months or 6 months or a year. So you kind of, start balancing these things out, and then eventually start slowing that down to where you're building out your full $10,000 position. And again, this would be if you're doing 10,000 in your long portfolio, which means if this is now 50%, right? That means your total account was 20,000. So you see what I'm saying here is when you look at this level, you're using 10,000 here, okay, long portfolio, and maybe, again, this depends how active of a trader you are or not, because for some people, they don't even have the upper end of the spectrum. But if you're just long investing, then what you're doing is okay, well, I might put 5,000 here and 1,000 here for a penny stock, speculative play, whatever. It's not you can't play penny stocks. It's just you use less cash. That's it. And then you got some cash on the sidelines. That's how you play the game of diversification, and time is your best bet. ETF versus mutual funds. I personally just buy an ETF. Why deal with mutual fund fees and problems and lock-ins? Because are you really shopping around at banks to get the best interest rate on your savings account? Like if one offers you 0.08%, let's say on a percent, and one offers 0.082, are you going to switch banks? No. Same thing here. Sometimes it's just not worth the trouble. So anyways, that's just a personal thought in my opinion. Of course, for those of you that are maximizers, yeah, you'll try to find the exact best one for the best rate. If you're a satisficer, you just want to satisfy yourself, you just get one, get it done, and then you move on with your day. All right, is it time to sell all or part of your portfolio? Kashmir asks. I would say, hey, kind of the opposite a little bit. We're adding to the portfolio. Still holding on to some stocks I had down between 15 and obviously below my stop. I can hold on for another couple. Should I get out? Again, depends. If you're holding on for a few years and you're looking for the next 5 years, I say you're already at that level, so you might as well just maybe hold on. Again, I can't advise you. I don't know your personal situation. But as far as, are these at a better value? Yeah, absolutely. You're down 4 years, right? 4 years worth of gains gone. So again, you get dividends though, if you get dividend stocks. What is your opinion on midterm perspective on banks? I think midterm, we're probably going to get a snap up sometime soon. That's just the nature of things. Would you put in the long term? What type of investments would you put in the long term and medium term quadrants? Okay. All right. So let's look at how I would set up a trade, just so you guys are aware. And then look at what stocks. The stocks are a personal take. Honestly, if I was to do it and I tell my buddy what to do, I would keep it simple. I wouldn't even worry about too many stocks. I would just look at getting, if you want to keep it simple, just depends on how experienced you are. Get something like a SPY or a IWM. That's it. It's not rocket science. That's it. Because SPY gives you a dividend. So let's check this out. Watch. SPY dividend. Now, it's not as good as a stock, right? But you got a dividend. So when you look at this on the dividend right here, you're getting 1.57. Now, if you go ahead and get Disney stock, let's say Disney dividend, and you check this out, you're going to get, what, 0.88? And then if we look at, I think Apple is also a weak dividend. P&G dividend, I think, is a stronger one. Here is, what, 0.74. So you've got all these different stocks with different dividend amounts. If you find some that, hey, you like to pay higher dividends, but remember, the higher the dividend usually, what's going to happen is with a higher dividend, the chart isn't always as fast, right? It's one of the reasons why Apple doesn't give you as much of a dividend, because it knows you're valuing the company's growth. So that's what happens is when you're looking at those things, you're looking at the growth. And let's see here. Just do it this way. Apple dividend. And then we'll look at what kind of stuff I would put in. 0.77, 0.73. So again, they don't pay as much. If you get higher, riskier investments, I think AT&T, so that would be T stock. And T, dividend, sorry, dividend. They used to pay a lot more, so I don't know what's happening here. But they were paying a lot, 6.03, 0.52. So anyway, you could do your research on these dividend things. As far as for me, keeping it simple, I would say just get an ETF and call it a day. There's a lot of Vanguard ETFs, high dividend ETFs, so stuff like this. VYM. I used to have some of this actually when I was just, hey, put some money away and don't want to think about it. So just to give you an example of VYM, even this one's down, but what happens is you know, you just kind of set it and it's diversified portfolio based on dividend stocks, and that's it. And you're looking at kind of the value, and it's not too expensive, right, compared to some stocks. So looking at individual ones, I would look at stocks down in a big way that you don't mind holding for the next 10 years. So what is that to you? Well, your taste might be different than mine. I would say, hey, maybe a tech company might be good. What's your, maybe a, you know, you check out Boeing, how badly that's hit. These airline companies, you know how badly they're hit? Oh my God, you know, they're toast. They're toast, right? With all the flights, the borders, they're closing things down. It's the same thing, Carnival Cruise Line and American Airlines, right? We just had a question as we talk about it. AA, what's the American Airlines thing? I forgot. American Airlines, AAL, there it is. So if we look at this, again, these things are toast. Now, will they probably recover? Yeah, more than likely. But again, would you want to buy it this low? That's a big question. We're going to talk about some options here in a second when we look at the options market. So I'll show you what I would do. Home Depot, you could see some of these, you know, they tank quite a bit. And hey, is it not a bad time to start adding things in? Yeah, this is kind of the starting point. You look at things like Johnson & Johnson, you got to almost get to the weekly chart. Like, see this one, it's not down enough to kind of get interested because it also had some problems in the past. But anything that's down quite a lot is a panic sell. So things like Lowe's, I would be more interested in. You know, as long as they pay dividends. If you're going more dividend kind of style. If you're looking at that, credit card companies also are really typically good, like MasterCard, Visa. I remember when MasterCard was up at $700-800 a share. It was crazy. McDonald's also, I think it was doing really well. You know, Americans love McDonald's, and really it's more of a real estate company. Because do you really think the government, you know, if the world is going to end, then if that's what you think, if the world is going to end, then you shouldn't be in stocks anyway. You should be, you know, taking a boat in the middle of the ocean. But if you think we're going to continue and live on, then in that case, looking at things like McDonald's, if the restaurants will open eventually, let's say in the next 3 weeks or a month or 2 months, you know, if the world you think will continue to go on and survive this, then you know, things like a McDonald's, it's really oversold in a big way. So you look at some of these things and you're coming back down to these levels. That's a nice move down. Netflix, you know, I'd be surprised. You probably have more Netflix subscribers now. It's a funny joke. Was it your grandparents, you know, when they were fighting their war, they had bullets and gunfire and airplanes shooting them down. But over here, what we've got, you just got to sit at home 2 weeks watching Netflix, 3 weeks watching Netflix. So anyways, I thought that was kind of funny. But when you look at this, I think Netflix subscribers might actually go up. So we'll see how that plays out on the earnings. You know, same thing like Nike. They have a lot of things in China. Could be an interesting play as well. Fang-wise, for those of you asking about Fang, I think, you know, these are typically way too strong anyway. And because of that, when they move so fast, they're going to always be the hardest hit initially, but you'll probably look to get a bounce soon. Now, whether it's a bounce over there or a bounce somewhere around a lower level, you'll probably get that. The same thing, let's say Netflix we talked about, Fang, what do we got, Google, Alphabet. So yeah, these things will survive. Digital companies, who knows, maybe more people will be taking up YouTube as a career now. They'll be staying at home. So we'll see. $1,000 mark seems like a nice logical place to bounce, but again, these things could get oversold and then get into that level. So that's what I would look at. Now, as far as there's so many products on sale with cash, like I said, the ETF is probably the better bet. Now, looking at what I would do as far as investment types and the way to structure it, like you can see the market right now, we're up 131 points. With the volatility, such big volatility, you want to protect yourself. We've got the VIX down about 10 here. So for those of you that are trading options, this is the way you structure your bet and your trade. Let's say I want to pick up, let's see, Tesla. You got it, Juan. Let's talk about Tesla. Let's say I want to pick up Tesla for long-term investment. Here's how you do it. All right, Tesla, down in a big way, right? Let's say this thing is coming down here. You want to be a long-term investor of Tesla. Again, I'm not talking speculative. I'm not talking monthly returns. I'm talking medium to long-term. And let's say this is you're interested in, you think it's going to survive. And you're looking at this. Current price of Tesla is, where are we today? 454. Okay, so if we're at 454, this is the way you structure a trade if you're a professional in these kinds of markets, or you just have more experience. I'm not saying I'm a professional. I'm just saying I've had the opportunity to lose probably more money than you guys. Just made probably a lot more stupid mistakes in my day as well. So anyway, the point being here is the way that the money managers structure their trades is through protection. And how do you do that? How do you set it up? We'll do Quest here. Vic asks about Quest. Do you really think it's going to be a depression? Yeah, it could be, because they're shutting down the government. So if people are out of work, people get fired, then, if you don't have a job and you got millions of people out of work, you can't run and operate a government, right? So, okay, let's check this out. We got Quest Diagnostics, the same thing. Let's look at setting up the trade. Here's the support. Call it 80, and let's look at Tesla. Here it is. I think Juan's a member, so let's do Tesla. Okay, so you could do the same thing for Quest. If we're looking at Tesla and we're looking to set up a trade, current price is 447 or 446. It's whipping around so much, but let's say 450. Okay. Current price is 450. If you were to buy that stock, you get it right at 450, right? I got a bunch of trades on here just to show you here. So we're going to then get it at 450. Not only does that take a lot of cash up, it's not typically the wisest approach. So if I was to get, call it 100 shares of Tesla, you're looking to pay about $44,000 to get that. So in our case, if you're still worried about the downside, how do you do this and how do you protect yourself? Well, the typical basic approach is, okay, you buy it and you go ahead and you buy a put with it. So this, we buy a put, let's say at 400. Okay, and now what does that do? Well, watch what's going to happen. Okay, this changes my curve right there to something like this. So now, normally, the curve, if I keep going down to 200, if the world is going to end, I'd be down, whatever, 24,000, because I own Tesla. It cost me 40,000 or something. If I buy a put, the most you could be down is 11,600. Okay, so the put saves you. Now, this is covered stock. You're buying covered stock, but you're buying it at the exact price that it's currently trading at. What if I could tell you, you could buy Tesla 10 or 20% below this sell-off? Here's the way the option market does it. So for those of you new and rookies and aren't doing options or don't understand options or don't want to trade options, let me show you. This is the ultimate way to do it. So this is called a cash secured put. Let's say I think, hey, I think Tesla's going to bounce eventually. If this is my thought and I want to be a long-term investor, getting it at 464 is a lot better than 900. But let's say, what if I could get it at 300 instead of 465? 300 better than 465? Yeah, absolutely. So here's how you do it. So you go to the 300, let's say you sell a put, and even then that has a pretty high percentage, but let's say we go ahead and we sell a single put here. Here we go. Sell single. And you check out this position and watch what this is going to do. This is going to give me a bullish position exposure to the upside. So what does that mean? This is the way this scenario works. Stock stands still, I make money. Why do I make money? Because these options eventually expire. I got a theta of 56. Every day I make $56, right? Stock stands still, I make money. Stock goes up, I make money. Why? Well, I got a delta of 17. What does that mean? Just like in the same way, if you were to buy 100 shares of stock, you got a delta of 100. That means for every $1 move up, you make $100, right? Because you got 100 shares of stock, $1 move up, you make 100. That's your delta. That's a price movement risk. In our case, with this, I've got a 17 delta. So I make $17 also if the stock goes up. And then what we look at is, the volatility. Now, this is a little too advanced for a lot of you if you're basics and options, but ultimately, if this thing pops, you have time working for you and price. And if it stands still, you make money. If it goes up, you make money. And if it goes down to even 300, you still make your money. How much money? You make $3,525 because you're selling these contracts. What does that mean? It means you've sold them. It means just like you sell a phone, a TV, you sell it. And when you sell, you get money. Somebody gives you money and you give them something. In our case, we're giving them a contract, an insurance contract that we don't think the stock will go down. Now, what's the big problem here? Well, if it goes down to 200, I have to give the stock to someone at 300, right? They put the stock to me at 300 is really what happens. So that means I have to take their stock at 300, even though the stock is down to 200. But does that mean I still get to keep my $3,525? Yes, absolutely. Sorry, I've been talking for a while. So I still get to keep my $3,500. So in either case, what goes on here is that you're ultimately saying, hey, I'll buy that stock at 300 in that case. And that's even lower. That's another 137 points lower than where we're at. Now, let's say you want to protect yourself. Well, why wouldn't you go ahead and buy a protected vertical, or basically buy a protection over here? Now, again, it's delayed just because of everything. Think of it like this. Okay, here's the way this works. Think of it in business. I sell something for 35, right? And I bought insurance at 28. So for many people, they have to think of it opposite. Let's say you buy a, let me reduce this. So that way, let's see if we can get an even number. 24, yeah, 30, 35. Okay, that's good. So let's say I buy a drum set for $25. I bought it for 25 bucks and then I sell it for 35. Do I make money or lose money? You made money, right? You bought a drum set for 25 and you sell it for 35. You made $10. So this is the way it works. So now you go ahead and you create, this is the spread that happens. You made a vertical. And ultimately the difference now is, now you don't make your 3,500, but you still make 1,125. That's how it works. Now, let's say you're really worried about it. Let me combine these spreads for you. Let's do a vertical. And let's see if I can make it kind of, again, nice numbers so we get basic concepts understood. Let's say I sell this vertical and let's go to 250. Okay, So here's Tesla. I sell the 260, I buy the 200, I make 11 and 20. That would mean I make $1,125. Now the big problem here is still this downward movement. That downward movement, it's still a little freaky. Well, what do you do? What do you do in this case? Well, can you still protect that? Yeah. Now you still got upside room. How much can you make? 1,110. You're making 14 a day. But if I want to protect this downside, what can I do? I can buy a put. This is the way it's done. Watch, I'll show you. So let's say I buy a put at about 200. Why 200? Well, we'll talk about it. Here, a couple of different ideas for you. Let's say we buy a put at 200. And now what's going to happen is, okay, am I making or losing money? I'm losing money. Why am I losing money? I bought something for 14. I sold it for 11. Did I make or lose money? You lost money. You lost $3. Well, how do I put the odds in my favor? Well, watch this, okay? What if I sell 3 of these or 4? 4 times 11, $44, and I bought one for 14 for protection. Am I making or losing money? You're making. You bought something for 14 and you sold 3 or 4 for 11. You made 44, right? And minus that other one. So what you're really doing by doing that is you're slowing down the decay curve over here, the slope of this curve. And it's just really the way the numbers work out. So you could do just 2 of these contracts and buy a single one, depending on how much protection you want. And what it does is it slows that decay down. And if you think the world's going to end, well, when it goes to 0, you actually would make money. In our case, it does slow down your maximum that you make. In this case, $810, not $1,110, but $810 or $830. It fluctuates now. But stock stands still, you make money. Stock goes up, you make money. Stock pulls back to 260, you're still good. So what was the whole point behind getting this single put? Well, behind getting this single put, so that way when you're down to the 300 level, if you had a vertical, you're not down 2,300. Instead, you're only down 860, but it's a long investment. You see what I'm saying? This is the way you operate in the marketplace. So that's what I wanted to share with you today. You know, if you're new to options or you're getting into options, definitely check out our website there on the Rise to Learn page. And there's a ton of great stuff. We've got our diagonals course also coming out soon. I might have to delay it by a week or 2 just because the volatility here is not as normal to do some sample trades. But if you check out some of those option courses, you can definitely learn quite a lot on what's going on, what's happening. Here's a trade. I think I did one on Microsoft as well. Is the same concept, really. I put this on as a spread idea for the butterfly course. And you can see what we're doing is that, okay, normally, right now, I'd be down $667 on this trade. Now, yes, we're up for the day, but in theory, we're down $667. Now, I also did it with pairing it a put, okay? And that put is up $549. Now it's down $670 for today, but it's up $549. Trading platform is Thinkorswim. Check the resources page as well on our website, but it is the Thinkorswim by TD Ameritrade. And if we go ahead and check this out, this one is making me money. This one is losing me money, but I can still hold it because I've got that put. Because, hey, overall, this position, I'm only down $73.83. That's it. That's it. And I got a long-term investment with protection. Now, if it stands still, how much can I make? Stand still, I can make $5,000. Now, that's a little tough, right, to hit the peak. If it goes up, logically, you make about $470, okay? It goes up and expires. If it goes down a little, I'm still okay. I might be down $230, maybe $300, $400, but it's not a lot. Now, without those puts, that's the problem. If I was down here, I'd be down about $1,600. So that's the way that it kind of works, and that's the way you should be looking at trades if you're more advanced. If you're more of a beginner, and you're looking to invest, you look at it diversification on capital through time. If you got 10,000, you put a little in, and you slow that down, and you're building your pot in your nest egg. If you're wondering how far the S&P can go, this is the big question. Excuse me, I'm starting to cough here. Just talking over an hour makes my throat hurt, so don't worry. It's just a lot of talking. So when you look at it here, as I mentioned at the beginning of the video, actually, I think it's possible we get down to 1,500. Is it likely? Probably not, but it's possible. It's possible. So that makes it, from a technical standpoint, possible. All right, so I think we're going to wrap this up here soon. So if you have any questions, let me know, and I'll see if I can answer some of them for you guys. All right, so you never buy a stock outright, correct? You sell options, and then you protect where possible, depending on the market and time. Yeah, I mean, it just depends what you want. Do I like owning stocks sometimes? Yeah, I think, yeah, when you have kids, when you're taking care of a loved one, a sick one, and you just don't have time to watch the market, there's nothing wrong with buying an ETF or a stock and just holding on to it for 5 or 10 years. There's nothing wrong with that. If you've got time to day trade, great. That's fantastic. If you've got kids, you probably don't have as much time. So it really just depends on where you're at personally. If you understand the options market, it's a little better and more cash friendly to use the options market. But again, if you've got if you don't have the time, if you got a day job, if your job is important, you're there all day long, there's nothing wrong with having stock. So anyways, so this is where kind of, let's say, leave things out. Oh my God, he's coughing. Oh no, not him too. Yeah. So anyway, maybe, more than likely, I'll probably get it eventually. That's the way I look at it. Statistically, I probably will get it. But the quarantine and all that stuff, economically, it's not going to work, right? Because eventually you'll get it in the same way that you got the chicken pox that many people have had, that kind of stuff. Anyway, so that's kind of what I would look at, is if you're a long-term investor, to keep things simple, diversify based on time. If you're doing things through the options market, you're looking at more something like any strategy with a protective put. Can I talk a bit on bonds? Let's see. I love weeklies. Which strategy? Weeklies, it's no different. Weeklies, the thing with weeklies is you have a bigger price risk when it comes to weeklies. The shorter the duration, Vic, the shorter the duration, the more price risk you have. The longer the duration, the less price risk, but less time decay you have. Okay, can you talk a bit on bonds? Yeah, maybe in a second here. When people demo trade real good and gain profits, but when they go live, the results are not the same. Yeah, exactly. Do you use margin on options? Yeah, options are on margin, but actually when you deal with, if your account, which I'm set up and equipped, most people don't know this, but there's two types of margin. Portfolio margin and regular margin, at least in the States. They don't have it in Canada and some other areas. But when you look at portfolio margin, the way that it works is that it basically, they look at your risk levels, and it's not like regular margin. So in a way, you get way more trading power. Let me see if I could pull it up here on another screen and bring it over. When you do it on a portfolio margin, is when you do it, let's see if I could find it. So there's a good site about it. They look at your risk based on leverage, right? It's kind of like getting a loan from a bank, and they won't give it to you. You have to take a test. So I've taken a couple different tests, and the way that portfolio margin works is ultimately, a lot of times what most people can do is, if you've got a portfolio margin, what you can have is a lot more stock or a lot more options in your account. So say, for example, you normally buy stock and you're using like 50,000. This is like standard margin account. When you're doing portfolio margin, what they do is they go ahead and, instead of 50,000, they only margin you like 30,000. So it's kind of like getting a free loan from the bank. What did you say S&P will go down to? I didn't say it would go down to any level. I said it's possible we could go down to 1,500, which is the highs of 2009 and 2000. Uber. Okay, I guess we're doing rocket fire here. Okay, last few minutes. Let's say Uber. Same thing. Let's check this out. Toast. Go get yourself some jelly. Toast. You might look for long-term investment, but these kinds of things, what you're waiting for, this is the way you look at these kinds of investments. You go in and you wait till you get kind of this bottom and sideways action, and then you're not going to be late to the party. You know, these things, don't think you got to jump head first in. It's kind of like the GoPro, right? It was selling off, you know, and you think, oh, let's get in it, right? So wait, and then you'll get the break, and that's when you get in. Let's look at Amazon. Yeah, toast, sideways. You're looking at, it's all toast, but the toast level is right here. You're looking at to get your jelly and sit tight. If you sell options, you could go down below the swing level here, which means all the way over here at 1100. What is the risk to be assigned with Microsoft position butterfly? It's right here. If we look at Microsoft butterfly, and you get assigned, first off, you're not going to get assigned until it's like 7 days or less. What's going to happen is that when you go in and get assigned, they'll just give you the stock. But if you're out in 7 days before the expiration, then you're not going to have problems. So when you look at, they have a thing called intrinsic and extrinsic value. I don't always look at it right here. Let's see. Here it is. Intrinsic value and extrinsic value. Okay, when this thing gets below 1 or 2, like right here, you could see these, you have a much higher probability of getting assigned. For now, because we have a lot of volatility, right, and a lot of time in these, you've got a 10, 14, and all these levels right here, you're not going to get assigned. Now, these options right here have a way higher degree of assignment. So in this case, you're not going to worry about it. You know, if it's you know, less than $1, you got a chance of assigning. If it's over $1, there's too much time premium. Because think about it, when you buy insurance, when you already bought it, you got it. For you to get out of it, it's like a contract. You're breaking your cell phone contract, then you know, people have to pay those additional funds. They've got insurance, they've paid for it, they've got time in it, so they're not looking to use it until it's really worth it because they've already got it. Doesn't matter if they cash it out today, tomorrow, next week. They'll just hold on to it till the last minute. So in our case, the assignment risk is very little until you get that, and that goes for most stocks, right? Once you're under about $1. And you're about a week or two away, that's a problem. In our case, when you got the value, when there's actually time value left, the extrinsic value, then you're kind of good. All right, let's see. What did I have before? Open interest, maybe. All right, let's see. Marijuana industry, yeah, some haters there too. Supposed to be worth billions in the next 5 years. What do you think about that? Yeah, maybe. I don't know. I never look at it like, hey, what's going to be worth 10 billion. I look at it step by step. If I'm trading Amazon or Microsoft, hey, is it going to go up? Just do it every single month. Just keep putting it on. Look at it as an investment. Is the question on your marijuana industry, if you're looking at it that way, are you looking at it as a spec trade or as a long-term investment? Because you got to think about these things, not just, hey, I mean, any industry can be worth billions if there's enough fuel or purchasing power, or if the government puts on restrictions, then you got problems, just like we're getting right now. Put highly overpriced, this means more downside in my experience. Okay, how much annual return do you aim for? What would be considered exceptional for normal risk? I mean, I would say for most people, if you're just getting started, you know, look to break even. If you're starting to trade a bit, look for 1 or 2%. If you're trying to do monthly, and you know, are you doing options or are you not? Are you doing shorter duration or are you doing long duration? I'd say on average, you know, you could aim for 5%. That's kind of a healthy sum, depending on your account size and your experience. If you're kind of busy and you're trading maybe 1 week out of the month, hey, maybe aim for 2% for the month. So, you know, in that case, just understand everybody's situation is different. If you've got kids, if you've got a sick loved one, if you don't have the time, you're going to be at different points. So understand that, there's a lot of marketing material that goes into pumping a lot of the online education for, hey, I'm a day trader. Here's my jet. Here's my car. And a lot of those things, they're just there to suck you in. Instead of the panic, they're there to suck you in for the euphoria of all the money you can make. But that's not realistic. Be real. This is what we're looking at. This is more legitimate. Bonds. Let's check out bonds real quick. If you're looking at bonds, typically the TLT is the big one, the 20-year Treasury bonds. You can see they've pumped a bit recently with the market sell-off, and that's because people are fearful. I don't think there's anything bad about bonds. They're just slower, and it's a good way to diversify things. So, yeah, you could still get in them now if you think, hey, there's nothing wrong with that. But 20 years is the typical bond thing. And bonds, they just move slow. If you look at the breakout point, yeah, here was our breakout, here was our movement up. And you saw that earlier, before even the sell-off. People were getting into bonds. Who was getting into bonds? Yeah, think about it. The big boys, they already knew they were going to dump the shares, more than likely. They were getting in it months in advance. So that's what was happening. And then boom, they breaking out and skyrocket. So that's the bond market. The other thing to watch is the DXY, not, what is it, the US dollar. I don't know if this platform has it. US dollar, DX, I don't know. It's the DXY. I think it's the other platform. Watch the dollar, see how, let me see if I can find it on here. The DXY dollar index is to watch. Yeah, the DXY, I don't know why that platform's not pulling it up. It might be listed under a different ticker. Is to watch how the dollar behaves as well. Yeah, I still, personal coaching, yeah, absolutely. Still working with some people. We have some things scheduled. So if you're interested in coaching, just check it out. We can do one-on-one sessions, video coaching right here. And you can learn more about it, what it's all about. Typically 45 minutes one-on-one. All right, what do you think about the oil industry? Hey, gas prices are cheap now, right? If you take a vacation, perfect. Nobody's on the road. Actually, I took a little drive this morning, and yeah, there's no police. I mean, really, you would think, hey, people would probably start looting and robbing things, but I guess we're more civilized for now. But it's all a lot of panic right now. But oil industry, they also pumped a lot of surplus, so gas prices are down back to almost when I started driving, actually. So I started driving. I remember gas prices being $1.45 to $1.40, $1.60. And now I've seen $1.79 in some places. How to choose what to buy and when are there many products on sale? How to distribute cleverly available. I'm a dividend investor, 30 years old, so looking for long-term. Yeah, Edgar's, we talked about this. Do it based on time frame, diversify on time frame. A lot of products, you could just do an ETF. They're already diversified. They got 500 stocks here, 3,000 there. So you're already diversified. You could keep it simple. Yeah, you could try to maximize those things, but it's not always worth the time. So again, it just depends. If you're long-term, something like that, or pick 4 or 5 stocks and hold on to them. So that's it, really. Okay, any other final questions? Otherwise, I'm gonna sign off. Probably the longest webinar live session I've done, almost an hour and 20 here. So thank you guys for joining me. Truly sorry about the economic status. I know any long-term investor, though, is losing money in this case. It's just those are the conditions. The value of properties is down. So again, it's finance, and it's one of the reasons why I always say there's more to life than money. You gotta live life abundantly, and once you're not living it, you can't go to a restaurant. You can't do this. It's like, oh my God. Well, now I can't even do that. Can't even go to the gym. Well, you got to work out at home. You can't even do this. You can't take your kids to school. What? Can't go to festivals. How far will the Dow go? Yeah, give this video a thumbs up. Yeah, thanks, Derek. Give the video a thumbs up. How far will the Dow go? I don't think I have the Dow Jones on this one, but yeah, it's the same as the S&P. You're looking at some of those lows in 2000 or the highs in 2009, 141. So 14,000, 15,000, maybe. It's possible. I'm not saying it will. I'm saying, you know, if we get oversold, that's the problem. Vanguard, I would say what's cool about Vanguard, one last point, is you could get a retirement, which I also recommend to some people. Not that I'm a personal financial advisor. I never really took any of those tests or anything. I didn't really care for them. But you can get a flexible strategy that continuously adjusts. So when you get to go ahead and it's an adjusted Vanguard investment. So it's based on your age. So it's called I believe it's called a life cycle fund Vanguard. You can get it with other companies too. Here's a life cycle fund. So let's say you're like 30 years old and you want to retire in another 30 years. So they'll give you more risky assets at first. And then in 10 or 20 years, they'll give you less risky. So it constantly adjusts. Let's see, here's a target retirement fund date. This is what I'm talking about. So let's see if it shows you. So, okay, so it tells you based on your target retirement date, let's say you're 20, you know, target retirement date is 2040. So it's just based on your birth year, right? So if you were born in, let's go from here, your target retirement date, maybe 2045. So what it does is it goes ahead and adjusts. So you have more risk at first, but then what it'll do is it'll do less risk and then less risk and then less risk every like 5 years or something like that. So that's kind of what they work. Okay. Hey, thanks, Crypto Trading Library, man. You're an awesome guy. Thank you. Hey, I truly appreciate you guys sticking with me, especially those of you that, you know, been there all the whole session. Truly appreciate you guys sticking around, just throwing some ideas here about the market, economy, you know, and stay put. If you want to stay put, enjoy life. If you want to enjoy life, you know, virus is already out there, but you can't live in panic your whole life either. So, you know, make the most of it. If you got kids, try to set up routines and those kinds of things for them, because that's important. You know, it's more about the family, I would say. So I wish you guys the best. I think you'll be fine. You know, a lot of people, if you look at the recovery, coronavirus recovery, you know, most people recover. So if you look at, you know, the science behind it, I don't know what the full numbers are, but out of those 100,000 people, more than 70,000 people have recovered from the virus. So, you know, you look at it, you know, you should be fine. Don't stress too much, because the stress is going to eat you up much more so. Stay well, stay around positive people. And if you're trading, fantastic. Do it with some puts. Be careful, because the market will have upswings and then it'll whip it back down. Be protective of those. And if you're not, wait on the sidelines till we have a multiple days of up days, because you're not going to miss out. 2-3 days worth of gains, or a week or two of gains that you think you're late. It's not going to be a big deal later on. All right. Wish you guys the best. Enjoy. All the best to your families, and I will see you next time. Thanks.